Modern digital infrastructure operates at an immense global scale. From the outside, the enterprise looks like a single, solid monolith. Inside, it is a constantly shifting mechanism of legacy assets, new acquisitions, and regulatory pressures. For the financial year ending March 2026, Tata Communications reported a consolidated profit after tax of 996.85 crore rupees on a total income of 25,104.45 crores. Those consolidated top-line figures cover a much more complex reality. Beneath the audited totals lies a landscape of structural reorganizations, subsidiary divestments, and significant off-balance sheet regulatory threats. To understand the actual operational health of the company, we have to apply a quality of earnings analysis. We need to strip away the accounting noise to isolate the recurring run rate of the business. Relying on the headline profit for evaluation assumes these figures are purely operational. But as we will see, the real equity story only emerges once we deconstruct the footnotes. This analysis follows a three-step framework. First, we clean the profit and loss statement. Second, we evaluate the core operating segments. Third, we discount for off-balance sheet risks. We start by cleaning out the noise. FY26 involved several exceptional items, ranging from provisions for new labor laws to strategic divestments, that change how we compare these results to previous years. Next, we break down the operating segments. Separating recurring cash engines from legacy anchors is the only way to model future cash flows based on current performance. Finally, we quantify the contingent liabilities. These are tail risks buried in the audit notes that directly threaten the balance sheet. This three-part deduction provides the necessary defense against mispricing the firm's forward-looking risk profile. This waterfall chart shows the company's reported profit before tax, starting at 1,437.89 crore rupees. Note 3 of the financials reveals that this baseline includes a net exceptional loss of 97.96 crores. Within that loss is a 60.58 crore provision. The government of India's new labor codes altered the definition of wages, forcing the company to record immediate actuarial impacts for gratuity and compensated absences. That regulatory hit was offset by internal controls, specifically a 114.64 crore benefit from staff cost optimization provisions realized during the year. Context is vital here. In FY25, the profit before tax was inflated by a massive 691.47 crore exceptional gain. That prior year gain was driven by non-recurring events, primarily a 733.02 crore profit from a one-off asset sale and reversals of historical interest provisions. If we ignore Note 3, a standard year-over-year growth model becomes highly inaccurate. The core operational profitability was vastly different than the headline totals suggest. Note 6 requires us to remove the final layers of accounting noise, operations that are no longer part of the enterprise. In February 2025, the company divested its entire stake in Tata Communications Payment Solutions Limited for roughly 423 crores. This ATM and POS network was a distinct business model from core data. When we also account for the loss of control in certain foreign subsidiaries, the consolidated historical revenue baseline shifts significantly. By stripping away the exceptional items and the discontinued operations, we arrive at an adjusted core PBT. With the statutory and divested noise removed, we finally have a clean baseline to evaluate the actual cash-generating engines. This tree map visualizes Section B of the financials, showing the segment result against capital employed for each unit. The Voice Solutions segment appears here as a flat, declining legacy asset. It generated only 116.16 crores in segment result. For the broader enterprise, long-distance voice is no longer a primary driver of value. In contrast, data services is the operational core of the modern business. The scale here is significant. Data services drove 24,802.72 crores in revenue, accounting for the vast majority of total volume. This segment produced an 1,180.51 crore result, confirming it as the primary operational cash engine. Within the portfolio, the campaign registry segment acts as a high-margin driver. This business processes robotic campaign information to reduce spam for mobile operators. It delivered a 422.76 crore result on only 844.3 crores of revenue. Effectively, telecommunications is now a data and digital platforms business. Valuation models that continue to weight legacy voice as a growth driver miss the shift in where the company's capital is actually deployed. While the operational engines are running efficiently, the balance sheet faces a shadow from significant off-balance sheet regulatory risks. This balance scale shows the company's standalone net worth, which stands at 10,578.69 crores. However, the auditors have included emphasis of matter paragraphs in their report. This is a formal signal regarding material uncertainties that exist outside the current financial statements. Note 4 describes show cause come demand notices from the Department of Telecommunications. These notices span nearly 20 years, from 2006 to 2025. The total demand from the DOT is 7,844.57 crores in adjusted gross revenue license fees. Management maintains their specific licenses are exempt from the 2019 Supreme Court judgment on AGR, believing they can successfully defend this position. Note 5 adds an international risk, a finalized VAT penalty in Spain amounting to 362.29 crores, which is currently being appealed. The core data operations appear sound, but these two legal battles rebate potential outflows that exist entirely outside of the standard operating P&L. This creates a very clear dichotomy: a modern, highly efficient operating business tethered to heavy legacy regulatory litigation. Management is actively reshaping the portfolio to focus on digital infrastructure, evidenced by the divestment of the payments business and the acquisition of Commotion Inc. But the value of those operational cash flows must be measured against the specific math of the balance sheet. Taken together, the combined contingent liabilities equate to roughly 74% of the company's entire standalone net worth. Ultimately, the decision to invest comes down to a specific mathematical tension: whether the growth in the data segment can outpace the 7,800 crore tail risk sitting in the footnotes.